The headline screamed, UK bond market in turmoil and gilt crisis deepens. The front pages were filled with dramatic language, painting a picture of chaos and uncertainty in the financial world. It sounded terrifying, as if the country's finances were on the brink of collapse and everyday life might be affected overnight. People everywhere were left wondering if their savings, pensions, or even jobs were at risk. But let's pause for a moment and look past the panic. What does a bond crisis actually mean for you and your money? Is it really as disastrous as it sounds, or is there more to the story than the headlines suggest? For most people, it sounds like complicated financial jargon, something that only city traders and investment bankers need to worry about, not regular folks going about their daily lives. The news focused on the falling prices of government bonds, or gilts, making it seem like a disaster for everyone involved. But here's the key. When bond prices drop, yields rise, meaning that new buyers can get a better return on their investment than before. This is a fundamental part of how bonds work. The media loves a crisis story, but often skips the basics. A government bond is just an IOU, a promise to pay back borrowed money with interest. You lend money to the government, you get paid interest regularly, and at the end of the term, the government pays you back the original amount. It's a simple, time-tested system. So, when you hear about a bond crisis, it's important to ask, crisis for whom, exactly? Who stands to lose, and who might actually benefit? For the government, higher yields mean borrowing is more expensive. They have to pay more to attract investors, which can put pressure on public finances. For those who already own bonds and want to sell, falling prices can mean losses, and that's where the pain is felt most sharply. But for investors with cash on hand, or those looking to put their savings to work, it's a completely different story. Suddenly the returns on offer are much more attractive. This so-called crisis is actually a rare opportunity for savers and cautious investors. Higher yields mean you can lock in a better income, backed by the government's promise to pay. The headlines often miss the fact that higher yields can be great news for new investors, offering a chance to earn more from safe, reliable investments. Instead of panic, this could be the best chance in years to secure a solid government-backed income stream, something that's been hard to find in recent times. So, before you get swept up in the fear, let's dig into why falling bond prices might actually be the opportunity you've been waiting for, and how you can make the most of it in today's market.
When bond prices fall, yields rise. It's a simple seesaw, and this relationship is at the heart of how the bond market works. Many people see headlines about falling bond prices and immediately think it's a disaster, but there's another side to the story. Imagine a bond issued at a $100, paying $2 interest each year, a 2% return. This is what you'd get if you bought the bond when it was first issued and held it until maturity. But let's say panic hits the market and the price drops to $50. You still get that same $2 interest, but now because you paid half as much for the bond, your return has doubled to 4%. Suddenly what looked like a crisis for some becomes a windfall for others. The so-called crisis actually doubles the income for anyone buying in at the new lower price. For new investors, this is a rare chance to earn much more from the same investment. This is why falling bond prices can be a massive opportunity for investors. It's like buying future income at a discount. You're essentially locking in a higher yield for years to come, simply because you acted when others were fearful. For years, savers endured rock-bottom rates, watching their money grow painfully slowly in the bank. Many felt there was no alternative, and missed out on better returns elsewhere. Now, with bond prices down and yields up, you can lock in returns that seemed impossible just a few years ago. It's a dramatic shift, and it's opening doors for ordinary investors and retirees alike. Think of it like a property crash. Bad news for sellers, but a golden chance for buyers who have been waiting for the right moment. When prices fall, opportunity knocks for those ready to act. The same logic applies to bonds. Lower prices mean higher yields, and that's good news if you're looking to invest for the future. If you're new to the market, this is your chance to secure higher returns for years ahead. By stepping in now, you can benefit from the market's fear and uncertainty. So next time you see a bond crisis headline, reframe it in your mind. It's actually a bond yield opportunity. What looks like trouble for some can be a turning point for you. The government is, in effect, having a sale on its IOUs. Bonds are being offered at a discount, and that means higher income for those who buy now. For frustrated savers, this is the moment to pay attention. After years of low returns, the tables have finally turned, and new opportunities are emerging. Market fear is creating a rare chance to lock in a predictable government-backed income stream. These moments don't come around often, and they can make a real difference to your financial future. Let's take a closer look at how we got here, and what it means for your money going forward. To understand today's bond yields, let's rewind to 2016. After the Brexit vote and years of low rates, lending to the UK government for 10 years earned you barely 1%, sometimes less. Savers faced a tough choice: accept tiny returns or take big risks in the stock market. Then, the pandemic, Supply chain chaos and global events sent inflation soaring. The Bank of England hiked rates, making old bonds with low coupons less attractive. Prices fell, yields soared. Fast forward to late 2025. That same 10-year bond now yields around 4.5%. Lending to the UK government now pays 4 times more than it did a few years ago. This isn't a risky bet, it's one of the safest investments you can make. The shift from near-zero returns to attractive yields is the real story behind today's opportunity. Not long ago, cash was king. People flocked to cash savings, relishing the security and flexibility it offered. With interest rates climbing, holding cash in savings accounts or money market funds seemed like a no-brainer. The returns were attractive, and the risk felt minimal. Savings accounts and money market funds offered some of the best rates seen in years as central banks raised rates to combat inflation. For many, it was the safest way to grow their money while waiting out economic uncertainty. But there's a catch. Those high rates are variable. They can change at any time, and they almost certainly will. When the Bank of England starts cutting rates, which experts predict could happen as soon as next year, those attractive returns will quickly shrink. That 5% you're earning on your savings today could easily drop to 3% or even lower, leaving you with less income than you expected. This is where bonds, especially government gilts, come into play. By buying a gilt now, you can lock in today's high yield for the entire life of the bond, protecting yourself from falling rates. For example, a 5-year bond paying 4.5% guarantees you'll receive that rate every year for 5 years, regardless of what happens to interest rates in the wider economy. In essence, you're trading the uncertainty of cash returns for the certainty of a fixed bond yield. This can be a powerful move, especially if you believe rates are headed lower. If you expect rates to fall, locking in a high yield now is a smart strategy. It means your income stays steady, even as new savers see their returns drop. Bonds, once overlooked in favor of cash, are now making a comeback. They offer a way to secure today's excellent rates for the long term, providing stability and peace of mind. The balance of power is shifting back to bonds as more investors recognize the value of locking in predictable returns. For anyone seeking reliable, predictable income, especially retirees or those planning for the future, this truly is the great reversal of 2025. So, what does the yield curve tell us about what's coming next? Let's take a closer look at what the future might hold for savers and investors alike. The yield curve shows the return for lending to the government over different time frames. Normally, longer loans pay higher yields, but right now the curve is inverted. Short-term bonds pay more than long-term ones. For example, a 2-year bond yields 4.8%, while a 10-year yields 4.5%. This signals the market expects rates to fall in the future. Investors are eager to lock in today's rates for the long term, even at slightly lower yields. An inverted curve often predicts an economic slowdown and future rate cuts. The message? High short-term rates won't last. Locking in a long-term yield now could be a smart move. The window to take advantage of this rare situation is open. Now, let's talk tax. How much of your bond yield you keep depends on how you invest. ISAs and SIPs are the best wrappers. Returns are completely tax-free. Each year you can put up to $20,000 in an ISA. In a SIPP, your investments grow tax-free until retirement. If you invest outside these wrappers, things get trickier. Bond income is taxed as savings income, with a small personal allowance. Anything above is taxed at your marginal rate. But here's the key. Capital gains from UK government bonds are tax-free. This unique feature makes gilts especially attractive for tax planning. The type of bond you buy can make a huge difference to your after-tax return. Let's see how this works with two investors, Priya and David, both higher-rate taxpayers investing $10,000 outside an ISA. Priya buys a high-coupon bond paying 4.5%. She gets $450 a year, but after tax she keeps only $270, a net yield of 2.7%. David buys a low-coupon bond. He gets a tiny annual income, all within his tax-free allowance, and most of his return comes as a capital gain at maturity. That capital gain is tax-free, so David keeps the full 4.5% yield. Both invested the same amount, but David's after-tax return is far higher. The lesson? For higher-rate taxpayers, low-coupon gilts can dramatically boost your net returns. It's not a loophole. It's a built-in advantage of UK government bonds. Choosing the right bond structure is crucial for tax efficiency. Let's break down why this strategy works so well. Low-coupon gilts are a secret weapon for higher-rate taxpayers investing outside ISAs or SIPPs. The total return from a bond is coupon income, plus any gain at maturity. Income is taxed, but capital gains on gilts are tax-free. So, the smart move is to pick bonds where most of your return is a capital gain, not income. These are usually older bonds with tiny coupons, trading below face value. You get a small, often tax-free income, and a big tax-free gain at maturity. For higher-rate taxpayers, this can double your after-tax return compared to high-coupon bonds. For anyone investing outside a tax wrapper, understanding this difference is essential. So, is now a good time to buy UK government bonds? In short, yes. For the first time in years, you can lock in attractive government-backed income streams. Yields are high, around 4.5% for 5 or 10 years, compared to near zero just a few years ago. Interest rates are expected to fall, so today's high cash rates won't last. Bonds let you lock in these rates before they disappear. The tax advantages are superb, especially for higher-rate taxpayers using low-coupon gilts. Of course, we know investment is risk-free. If inflation stays high, bond prices could fall further, but most experts think we're near the peak for rates. For anyone seeking predictable income or a safer portfolio, the case for gilts is stronger than it's been in years. The window of opportunity is open. Don't miss it.